at that time, they said the limit to be considered a bank that is important to the system was $50 billion in assets. Okay. And after 2016, Trump administration came in, they did a reform in banking sector. They increased that limit to 250 billion. I mean, you still had big banks in there, like J.P. Morgan's, Bank of America, Citibanks, yada yada yada. But you didn't have First Republic Bank, Silicon Valley Bank. There was another bank that was in trouble. At the time Silicon Valley went down, they had assets of 200 billion. All right. Now, if you're a bank that is important to the system, the regulator actually lives with you. There's an in-house bank examiner. They basically go through your stuff every single day. If you're not one of those banks, you're examined on an as-needed and quarterly basis. So it would have been a lot easier to catch what was going on in Silicon Valley Bank if the original limits of Dodd-Frank had not been changed. This is not a political statement, it's a fact. Whether you think that regulation increased profitability of banks or not, that is debatable, but at least it's a debate. The fact that Silicon Valley probably would not have gone down is a fact. Because a regulator over there is going to see that the risk is there, we got to do something about it, and they would have raised the capital much earlier, or they would have taken other measures. So that's the regulatory part. The second part is lack of diversification of deposits. Silicon Valley Bank was basically the bank of the venture capital firms. They financed most of the new ventures anywhere from 2012 to about last year. I did some consulting gig for Accenture last year, and the client was Silicon Valley Bank. And we basically developed stress scenarios for them. We actually told them that this was an issue, that they need to do something about it. Most of their deposits are also these firms. In and of itself, that's not a problem. There are hundreds of firms like that, or thousands of firms. The trouble is, all of these, close to 90% of their deposits were not insured. When you and I put on a deposit into a bank, if it's below $250,000 per bank, it is insured by FDIC. Even if the bank goes down, FDIC promises to pay you. But you're a company, you got $1 billion in cash, you're going to need it, but you put it in a bank. Silicon Valley Bank was really competitive with these guys, so you put your money into Silicon Valley Bank. Profitability wise, they were doing very well, so an individual corporation had no reason to believe that Silicon Valley would go down. The trouble is, bank runs are contagions. And as interest rates start to go up, a lot of these corporations faced tighter credit conditions, and they started using that cash to finance their ventures. But pretty much all of their clients did similar things at the same time. Essentially, there was a run on Silicon Valley. And they kind of noticed this. They tried to raise capital for about $2 billion. They failed. As soon as the news that They came into the market, which was a Wednesday. People took out about $50 billion worth of deposits, a quarter of the deposits. Remember, banks do not keep those deposits as cash. They give them as loans or they have other assets. They had close to $100 billion in treasury bonds. They sold those treasury bonds to finance the deposits. The trouble is those treasury bonds lost a lot of money. They were long-term T-bonds. And there was a run on the deposits. They had to sell about 50 billion worth of long term. This is typically 20 to 30 years. Bonds and realized losses. And they could not raise new capital. Hence, were shut down. And they're open again, but with a different name. I don't remember who bought them. And I actually lost quite a bit of money on this, not because I had anything in them. We had developed another risk management project with them. The people that we had the relationship with, they were all fired. So we couldn't get that project. Let me put it this way. I probably would have spent at least 200 hours on that project, and my hourly rate is $250. Imagine how much money I couldn't make because of that. I mean, they bought treasury bonds when rates were around 3%. So let's check where the 30-year bonds trading. This is an indicative number, but it'll give us, actually, I want US 30-year. Let's look at 1 year. So around, this is kind of, they went down at the end of February. Yeah. The rates were around 395, okay? Let's figure out how much they would lose. Assume it was a 3% coupon. It doesn't change it too much. At the time they bought it, the financial duration is about almost 20 years. So let's make this on average 25 years. Okay. So duration was about 17, 18 years, depending upon the composition of the maturities. I'm just taking the shortcut, 17 and a half. So for each $1,000 value bond, they would have lost $175, okay? Or, no, that's the financial duration. So of their bond portfolio was about 17 and a half, and interest rates went up by about 90 basis points, or 0.90%. That means they lost 17 and a half times 0.90%. 15.8% of their bond portfolio out of 50 billion. So 50 billion times that is